And so we're putting the spotlight on the position South African investors are in at the moment compared to some of their international counterparts. And to run us through the status, Warren Ingram, Executive Director at Galileo Capital, joins us now live in studio. Thanks so much, Warren, for joining us this afternoon.
Good afternoon.
Well, let's first of all look at the context within which investors are operating right now, where on the one hand we've got this ongoing recovery of the US economy, but on the other hand, global markets still being unsettled by the pigs in Europe. On a global scale, things pretty tentative still at this stage of the game, right?
Absolutely. I think what you've seen in the US with that fantastic recovery and sort of the on the ground recovery with house prices starting to go up, people starting to borrow money again, starting to buy cars in the US, that's been really positive, and I think that's what's driven the world going forward. But suddenly, I think after a few months of great growth, I think the markets have looked at reasons to stop investing, and suddenly the pigs has come up, and the pig situation can't be new to investors. We've known about this for a long time. Perhaps the scale of the problem was a bit bigger than anticipated, but for the markets to panic like they did last week, just to me didn't make sense. So you're right. Yeah, I think the world is a little bit uncertain, but I think they need to be looking at America now, not at Europe.
If we look at America and hone in, a focus in that direction, we've also got other concerns weighing in terms of the fact that we could well see excess regulation on the financial markets coming to the fore. Just how unnerving has this become in terms of a factor that investors are considering right now?
Well, I think the problem is that the man in the street, so Main Street, is really happy about the over-regulation. They want to punish the banks, they want to punish the fat cats, which is fine and it's understandable. But the problem is, if you look back in history, the market always goes one of two ways. It either goes to complete deregulation or complete over-regulation. And I think that's what's going to happen now, is we're going to get to a point where Barack Obama and his government are going to completely over-regulate the situation and almost strangle the banks. And when they do that, that means the banks can't lend, they can't drive the economy, which is what their role is there to do. So I think that's going to be bad, and I think it's unsettling for people who are saying, look, we need to look at a 5 or 10 year view on how we grow and how we get investment companies to reinvest in the economy. And that's what's worrying me now, is I think it's going to be a knee-jerk reaction, over-regulate and hurt the markets again.
So let's take a look at the position of an investor who sits amidst all of this. I mean, it's leaving them in a difficult position with regards to their investment moving forward. How are you playing the game right now, and is there a distinction to be made between equities, fixed income side of things, or are we pretty much in the same boat all round?
No, I think if you look at the US or any of the European investors and the South African investors, they are in a similar position. They know that, for example, interest rates at some point must go up. So that means it's hard for them to invest in bonds or listed properties, for example, with a long-term view, because they know as soon as the interest rates go up, those investments are going to suffer. At the same time, you've had the equity market doing incredibly well up until last week. Perhaps it's starting again now, and they might be worried about whether that market's going to carry on running again. So typically what we would be saying to anybody, I mean, whether it's a US investor, European or South African, is if you don't have the correct allocation to shares and you're worried about the markets, start buying slowly. You can do it over 6 months or 12 months, but at least start getting into the market, because equities and listed properties, for example, are really the vehicles that are going to protect you against inflation over the long term.
You've documented, though, that South African investors are in a better position than their US and other developed markets investors. So let's run through some of the support factors for us specifically. And I think a good place to start would be looking at actual fundamentals of our economy. I mean, if you look at the macro picture, what's it looking like compared to that of the US, for example?
Well, the really good thing about the financial crisis was it showed how strong the brakes are in the South African regulatory system. We have things like the National Credit Act, which protected our banks from lending to people who didn't have the money, whereas, for example, in the US that just didn't exist. The banks there have and unfortunately continue to lend to people, I would say recklessly. So that's one thing where when the wheels fell off in the US, they didn't fall off here. Obviously, we felt the impact of just a global contagion, but the fundamentals of our financial system are extremely strong, have been and continue to be. And if you look at the overall economy, I think our economy is still in a very, very good position. We've got our government governments taking on debt, but not taking on debt to throw it down a black hole like the Europeans and the Americans are doing. They're taking on debt to fund investment in our economy. They are growing through the economy through Eskom, through road investments, etc. So if I'm the South African taxpayer, and I am, then I'm looking at this and saying, well, I don't really want to pay more tax. I am unhappy, like anyone would be, to pay more tax, but at least I can see the roads that are being redeveloped, my power grid which is being strengthened. If I'm a US or European investor, I'm incredibly unhappy because there's no investment in my future there.
Yeah. Well, if you look at what you've highlighted, I mean, it's been all pretty positive when you look at the South African context, but this is in the face of major issues that we have to contend with locally, where we've got, for example, political risk to consider. Perception leads us to assume that this tips the scale somewhat. To what extent?
Well, I think political risk is a factor we have, but political risk is a factor the Americans have as well. I mean, it's interesting, on the ground in the US, you'll find that, for example, there are massive divisions both between the Republicans and the Democrats. That's not really news, but the man in the street, for example, in the South, he's not a fan of President Obama, whereas the man on the street in New York or Boston or Washington, he thinks Obama is the next savior. So I think the divisions within that country are enormous, just as they are in the UK, as we're seeing with the elections there. And I think markets tend to focus on emerging markets. They look at South Africa and they say, well, our political risk is enormous, but it's no bigger or smaller than any other economy. The fact is, that'll be with us forever, like it is with any other developed world. So to me, I think what happens is those issues get overblown because we're an emerging market. The fact is we've got a great press system here which exposes all our problems, maybe a bit too much for our comfort, but they're there and they exist, and I don't think they're that big.
Well, certainly then a good time to be investing, but you are looking at a phased-in approach where equities haven't let us down, historically speaking, if you look back with a long-term perspective. Thank